When I come back Monday, we'll do a whole new other brand new coaching session. In the meantime, let me give a shout out and say good morning and welcome to the second hour of TheoTrade. I am Professor Jeffrey Bierman. I'm broadcasting you live from Chicago. And today is Friday. I would say thank God it's Friday, but it's not, because I have to spend the next 24 hours grading 50 midterms. It's absolute hell. And it starts at 9 o'clock today. So once I get off here, I just roll to the next job. Regardless, it's actually an interesting day, and I'll give you perspectives on this. So let me say good morning to the usual suspects. Hello, Peter Schrader. Guatemala, good morning. Good morning, Michael Gio. Good morning, Robro, John Dunn, Chris Shaw. Where's Bart F? Where's Ed? Where's all the usual characters? Where's Trains? Are you there? All right. I've got a lot to say, and yet there's so little time. But again, I think I'll get my point across at some point today. Good morning, Florida Woody. Good morning, Tailtex. Hey, Bart. So today's theme comes courtesy of an expression. Now, I want to clarify this, okay? The title of today's program is called Road to Nowhere. I know every one of you from ages 20 on to, if you're in your 90s, have heard the expression, it's a road to nowhere, okay? But I'm going somewhere with this. I've got a double entendre, which is French for double meaning today. So Road to Nowhere is two separate, there's two songs. The great Ozzy Osbourne, the Oz, wrote a song called Road to Nowhere, but that's not the one I'm referring to. I'm going with the Talking Heads. So how many of you out there, Ship, Terry Palmer, Trains, how many of you know the Talking Heads? Because I went to a couple of Talking Heads concerts. David Byrne is an absolute riot. If you didn't know, David Byrne went to MIT. They were all friends. Chris Franz, they were all friends at MIT. So you're talking the brightest of the brightest engineers in the world who shucked their MIT degree to become musicians. You got to love that, but the math in their head allowed them to do this. So there's a song called Road to Nowhere. You're like, oh, baby, talk to me more about it. I'm going to talk to you more about it right here. So here's the deal about Road to Nowhere. And I'm going to actually put the song up and walk you through this, because I think you need to listen to this for a couple of minutes. So here's the song, Road to Nowhere. I'm going to turn the sound up so you can hear it, and I'm going to walk you through the lyrics because it's capturing the market. So let me put it on pause for a second, okay? And let me walk you through this. Okay, it was written by the Talking Heads. Mainly David Byrne wrote it. And it comes off the album Little Creatures from 1985, which I still own. I still have the LP, believe it or not. And it reached number 25 in the US Billboard Album Rock. It appeared on the Best of Talking Heads called Sand in the Vaseline, popular favorites. And it was also in the Once in a Lifetime set box and the brick box. So David Byrne said, I wanted to write a song that represented a resigned, evil, joyful look at doom. He said, at our deaths and at the apocalypse, always looming, folks, I think I succeeded. The front bit, the white gospel choir that I integrated, is kind of tacked on at the end because I didn't think the rest of the song was enough. I mean, it was only 2 chords. So out of embarrassment or shame, I wrote it into the section that did more. So what does the Road to Nowhere represent according to David Byrne? This is in the words of David Byrne. He says, I'm exploring existential themes of uncertainty and the human condition. It begins with the paradox of knowing one's destination while being unaware of the past. The opening lyrics to the song describe this market. The opening lyrics are the current market in its current state. We know where we're going, but we don't know where we've been. Think about that for a second. We know where we're going, but we don't know where we've been. That's this market. This market continually goes Fed, buy, up. Down 2 days, buy. We're in such a, we're in a delusional market, completely manipulated by algorithms and Fed liquidity, as Garrett tells you every day. But the market never for a second ever considers where it's been. If you look down the mountain, we were at 4,800 about 6 months ago. We were on the fringe of collapsing, of crashing, of blowing out because of some tariffs. Oh, but no, okay. The market basically is just ripping higher. And David Byrne says the journey reflects it reflects a journey filled with both certainty and ambiguity, suggesting that while we may have the goals, the path to achieving them is unclear. So I just call this program, okay, the road to nowhere. And people like, why would you say it's a road to nowhere? Here's the music. There's the choir. And of course, David Byrne will jump in here in the video. This is from 1985. See the kid walking down the road in the desert in Arizona? Look. The road to nowhere. There's David Byrne in his funny dance. I just absolutely, if you've never seen this video, it is absolutely hysterical. So where am I going with this? Okay, there's always a method to Uncle Jeffrey's madness. Always. Always make sense of the cryptic and the curious. So let's talk about this. Let's talk about the E-mini. Okay, so we're on a road to nowhere, and everybody wants to take that ride. The road to nowhere means we know where we're going. The market thinks it goes up every day. The dippers, the call buyers, AI, the rush to zero DTB, you say it's going up every day, but you never look down. The lyrics are, but we don't know where we've been. You don't realize where you were. Do you realize where you are? I'm trying to get you like, put your risk helmet on. This ain't going to last. There's no way. It's not going to last forever. Oh, we may go to 7,000. Great. Look down the mountain. What are you going to do when this goes down? What are you going to do when the spigot turns off? The second part of the road to nowhere in reference is all we're doing is killing time. All we're doing is moving slowly up hypnotically, hypnotically moving up. But the one thing I'm certain of is this: the MACD is never wrong. It'll always presage and portend reversals or pickup. So I'm looking, and I'll show you, and to Eric F., who asked me earlier, I'll show you that I've been in a position now for 5 months, and it broke out today. It's going vertical. It's going to be the biggest winner in the Genesis COG. So Eric, if you're telling me that the Genesis COG is for 2 weeks, you would be wrong. Some of my positions last for 5 days, some last for 5 months. It's not about time, it's about how much money you make and what the indicators are telling you to do. So be careful how you label it. This is a road to nowhere. We're not going down. I know it. You don't got to tell me. It's rigged. We're at the end of the quarter. Who the hell is going to sell this? Nobody, and not you. I know that. You don't have to preach to me. It's not going down. I know that. But come on Wednesday, all bets are off. There's no more gaming the system. There's no more phony and faking and inventory. It's all garbage. It's all optics. When this rolls over, and it's going to roll over sometime, how long? Don't know. Don't know. I don't have the day or the hour. Nobody does. But the setup is what makes the Genesis COG so powerful. The setup is telling you, we're not going down yet, but we're getting close. That's what it's telling you. So you got to get prepared. Don't believe that we're going that much higher. The road to nowhere is telling you that you're going up and you're never going down. You know where you are going, but you don't know where you've been. You better be careful. And the second part of that is the road to nowhere means we're just going to trade sideways. I suspect we're going to trade sideways all throughout October. Most of it, at least halfway and through, until we get to earnings. Because the dippers and the window dressers, they just don't want this down. They have to post these monster numbers, another 12% year, put it in the books, blah, blah, blah. This is not a setup, I want to point you, for an implosion. But if this rolls and curls, all bets are off. All of them are. So that's what I mean by the road to nowhere. Now, 3 macros that are driving the market today, 3 of them. So let me bring it up to each one of you, if I may. We'll get right back to the beginning slide. Divided we fall. People scratching their heads. What does that mean? Okay. Divided we fall is a reference that came out And it's like on every headline of every major social site. But every business site's got it. Market Watch, Bloomberg, CNBC, pick one. Reddit, who cares? They're all the same. They're all saying the same thing. And I keep telling you this. The Fed is divided. It is divided, we fall. It is not in agreement. They are not synchronized. You have half of them who are saying, we don't want a rate cut. You got half who are saying, we need to give a rate cut. So you've got disparate opinions. It's a divided, like a faction of people. It's not a unanimous 13 going, we've got to cut rates. It's divided. And here's the reason why it's divided. Because half the officials in there are like, we are worried about inflation. We're growing more cautious over inflation. The PCE deflator comes out today. What did it show? An uptick in inflation. It's an uptick, so don't lie. Just the numbers are an uptick. The inflation went up again. Consumers are spending. That's why the market ripped up a little higher and then kind of settled in. The reason why it settled in is because the window dressers had to sell the losers and buy the winners. It's so obvious what you guys do. You don't fool me. None of you are fooling me. You're just like, let me sell the 52-week low. Let me buy the high. That's what you do. That's what you do. So when it pumps, you dump. When it dumps, you pump. That's what you do. So be aware that the Fed is not unanimous in cutting rates. The market has factored in one rate cut in October and one in December. If we get the rate cut, it's already priced in. If we don't get the rate cut, it's not priced in. So to me, it's a lose-lose situation. Be aware, the inflation data matters. But the other couple of Fed dissenters are saying, we've got to cut rates. We're really worried about the job market. I'm not worried about the job market. I'm not worried about it. What I'm worried about is there's not going to be jobs for people because AI is going to replace you. But I'm not worried about people getting laid off all that much. Okay, that doesn't affect, I don't care. Okay, so be aware, inflation over unemployment. The Fed has chosen unemployment over inflation. That's what they've done. The second macro alert, I call it red alert, because all of you understand what red alert means. I'm not going to fool any of you. Red alert simply means that the government, and I'm just the messenger, so please don't come after me. Please don't beat up on me. Please don't scream at me, okay? The budget office, which is part of the White House. They're a faction of the White House. They're an office, There's different departments in the White House. Department of Treasury, they're out there. There's Department of Defense. They're out there, right? Government comes from the White House. The White House Budget Office has already, as of this week, notified the different government agencies that you need to prepare for job cuts if the government shuts down. Notice how I said if the government shuts down. There's this debate. Now the sides both agree. It's usually one side against the other, and then they finally do a bailout, sign some fake bill, kick it down the road, and buy some time. This is the first time where both the Democrats and the Republicans agree that they're going to let the government shut down. They already agree to it. So if the shutdown comes, I'm not going to say, that's surprising. It's already forged in stone. But until they actually shut it down, I don't know. But I'm telling you, if there's a government shutdown, the budget office has already said, you better be prepared. There's going to be more layoffs of government jobs. How does that help the growth of the economy? It doesn't. It doesn't help the growth of the economy. So now it's looking worse and worse and more like Blake Young's on this. Blake Young is way ahead of this. Stagflation. We're looking at it. It's coming. Jobs slow down, government layoffs, higher inflation. This is just a bad combination. And the thing is, the market plugs its ears because the only thing that matters to the market is greed and liquidity. Just they're looking up the hill, road to nowhere. They're looking up. They're not looking where they've been. They've not looking at all. But once that momentum breaks, and again, it's like the Mike Tyson expression. Everybody has a game plan to beat me until I punch him in the face. That's what's going to happen to a lot of people out there. A lot of investors, a lot of brokers, a lot of money managers are going to go, oh no, I'm down 8%. They're going to freak because all they do is they think it goes up every day. And that's what's happened for like 6 months. We're up every day. Look at the algorithm channel. If we break those channels, okay, God help us all, because we're not prepared for this at all. We're not prepared for stagflation. We're not prepared for the Fed not cutting rates. We're not prepared for anything because the VIX is buried at 16. That's worrisome. The last is, and this is what I got to give a lot of credit. I am not a big fan of most. I'm not. I'm not a big fan of most hedge fund guys. I'm not. I like Boaz Weinstein. So does Garrett. I really like Stanley Druckenmiller. I think he's the brightest of the bright. He may be the best in the world at value. I love Druckenmiller. He's fantastic. I like Paul Singer of Elliott because he's a value guy who unlocks value. There's some out there. A lot of them, they come on TV, they're blowhards. I can't stand them. You're just riding momentum. But when it comes to number crunching, you can't do it. Einhorn is a notorious number cruncher. So what he says is this, and I call this the $1 trillion challenge. The $1 trillion challenge. Billionaire hedge fund manager David Einhorn is warning on AI spending. Now, before you go out thinking you know what's going on, okay, hold your tongue and listen to what I'm going to tell you. David Einhorn has expressed concerns about the $1 trillion spending on AI infrastructure by companies like Apple, Meta, and OpenAI, suggesting that such investments could lead to capital destruction. Did you hear what I just said, people? It's what we call in academic finance. We call that in my world at Loyola. It's called misallocation of resources. If you ask why markets crash, it's a misallocation of resources. You invest and spend money for an outcome that never comes to fruition. And when you sink all that money and the return on investment doesn't equate to that and it's below, you get a market crash. Market crashes are not about technicals, people. That's the market event, the economic true event of what causes market meltdowns, okay, is misallocation of resources. And Einhorn is ahead of the curve on this. He has questioned, that's the challenge. He has questioned whether the annual spending of $1 trillion or even 500 billion will yield favorable outcomes for these companies. Einhorn's warnings come as he continues to criticize the market for not rewarding smaller companies with capital, instead overinflating large companies that comprise the biggest ETFs. That's Garrett's point, that's Don's point, that's Brandon's point. The ETFs are driving this market because it's just like it's like a brain dead thing. It's like, set it on autopilot. Just buy, dip, buy. They're just buying the largest. Every dip is just being bought in all the large cap because of the AI narrative. There's no thinking involved, people. It's just buy off the 20. Exactly what Garrett says. Einhorn believes that the market is fundamentally broken, as do I. I've been telling you, it's broken. You money managers, you don't do any research. I do, you don't. I know you don't, because you're paying 75 times earnings for stocks with no growth. People are paying 50 times earnings for BAM, Brookfield Asset. Brookfield Asset has no growth. They've missed their last 3 quarters, and there's no raising their dividend. That's a bubble, people. Misallocation and arbitrage here. But he also says that the companies like Vanguard and BlackRock, okay, they deny shareholders the ability to improve conditions of companies or request changes. Einhorn's views reflect a broader critique of the current investment landscape and the need for a more balanced allocation of capital. So when the Fed floods the system, it's not finding its way into the places that are fundamentally the cheapest. It's finding its way to the largest, biggest, baddest, more overcapitalized stocks and just overinflating and making them more overvalued. And the ones that are left behind are the cheapest ones. And the money managers are like, I don't want to buy that because it's not financial porn. That's how the business now works. There's fundamental markets broken. The research model is dead. The only way I see to fix it, the only way, take 40%, cut the market down to 4,000. That will force money managers to dump charts and do some research. That is my dream. That is my hope. Einhorn and I are on the same page here. Now, individual stocks that are driving this market. Okay. Buyer beware. Buyer beware. Okay. I'm going to show something to a lot of you. And I said this 3 weeks ago. I said this 4 weeks ago. And I stand by it. And you can come at me. You can call me an idiot. You can call me a perma bear. I'm none of the above. I own a lot of long stocks. In fact, I just bought a little bit, okay, in the last couple of days. So don't tell me I'm not long, okay? I buy a lot of stocks. I just told you, this is a bubble. And a lot of you are going to lose a lot of money on this eventually, okay? You haven't seen it yet. This is the weekly setup of the Genesis column. The weekly, which trumps the daily. Again, when does the pain begin? The pain doesn't begin until you cross underneath the zero line. It is now officially below the zero line. So you come at me and say, they earned 587. I don't care. They beat by 7 cents. BFD, okay? You have to go back 4 quarters and realize that their earnings went from 530 to 580. If you actually do the math on this, their earnings were up 9%. 9. Now you go backwards and you tell me why you're paying 50 times earnings for this stock. If you did, I'd fire you. I don't care. I'd take you to court. You got to be out of your mind to buy this. They're growing at 9% and they trade at a 5-peg ratio. That's a bubble. You haven't seen anything yet. The market's up today. It's up. And this is one of those, I'm going to buy Walmart, I'm going to buy Costco and sell everything else. I'm going to buy Apple and sell. Again, it's the S&P 10, and this is part of that S&P 10 or the S&P 20. Call it what you want. I keep telling you, when that goes through and works its way lower and breaks through that zero line, it loses all momentum. All momentum. That's the weekly. If the monthly breaks, it's the end of Costco probably for, it's my guess, probably for a decade. You won't see it back at 1,075. How are you going to pay 50 times earnings for a stock that can't grow anymore? It just can't. The law of large numbers just dictates that you'll never grow at that level. Even Apple can't grow anymore. Apple's growth is stunted at 5%. You're just chasing performance is what you're doing, hoping an AI will unlock value. Good luck with that. This is, okay, if it breaks underneath 800, I think it's the end. So the dippers are going to buy because the chart looks sexy longer term. But I keep telling you, when that monthly starts to threaten underneath that signal, that zero line, that's where people buy the dip and get wiped out in the business. The weeklies are broken. The dailies are broken. It's under the 50-day moving average. It's under the 20. I advise all of you, lighten up on this stock. Lighten up or get the hell out of this stock or hedge it. This stock has a long, long way to fall to align with true value. Buyer beware. Second thing I'm throwing out there is this. Fortune teller. Yesterday news came out and somehow during the day, nobody at Theo picked up on it. So I'm going to run with it just for kicks. So IBM, okay, had a monster run yesterday. There it goes again. Another algorithmic incursion. Are you short? You're dead. You're never getting out of that today. You can forget it. What money manager in the world is going to sell it when it's vertical? Not one, baby. Not one. Did you get the news on IBM? Okay, here's the news. IBM unlocked. I don't know if anybody saw this, so I'll see if it's over here. Maybe it's still over here. IBM had a quantum breakthrough. A quantum breakthrough. IBM claims that they can now go into the financial industry and they can predict market outcomes. That's what IBM says. They can predict market outcomes. Quantum computing is going to change the face of Morgan Stanley, Goldman Sachs, Blackstone. That's what IBM is telling us. That's why it went up 5%. That quantum computing is the future. And that AI is kind of like right now, it's up there, but this is going to be bigger and badder. Really? Here's the thing. Rigetti, which is a part of AI computing, RGTI, okay? You saw it run up here, get badly, okay? This is following with IBM. But here's the rub. A broker-dealer came out yesterday, and said that his estimate of the entire value, market cap of the entire value of the quantum computing market for 2026, which is a year from now to December, we got 14 months. His entire market cap is $5 billion. That's the market cap of that's how much money it's worth. Really? People, did any of you do the math on this? The stock's at $30. They got 300 million shares. This stock is valued already. This stock is valued already at $9 billion. That's a $9 billion stock. Did you realize that? This company alone is worth twice as much as the entire market cap of what this brokerage firm said that the quantum computing market is. So what's my lesson here? All these people don't know anything. They don't know. They're just guessing. Okay, how is this twice the size? It means either this stock is overpriced or the analyst who came out with his estimate is like an airhead. It's one or the other. Either he's way underestimating or he has a zero he forgot to add, or this is a bubble. It's one or the other. I don't believe this is a bubble. I don't at all. I think that analyst needs to go back and like double check his facts. For $9 billion, $5 billion for the whole industry, this stock alone is worth $9 billion. Do the math. How could one stock be worth? That means IBM's worth zero? Come on, somebody screwed up somewhere. Analysts. Ugh. You never help me say like, analysts can't use them, can't get rid of them. Exactly. Plant now, sow later. That's the next one. Plant now, sow later. So Trump comes out and says, I am not going to slap a tariff on any company who builds a plant in the US in the next year or two. He wants all pharma to be, migrate from overseas, build the moat and put it back in the US. Now, I'm down with that. I have no problem with that at all. So this stock gets the news that Trump is not going to, he's going to slap zero tariffs on Merck. None. Because Merck just built a multi-billion-dollar plant in Arizona. Did you know that? So the stock opens up. It opens up already. Look at the pre-market. It opens up near 79 and sells down. Why? Because it's not financial porn. Your money managers who bought this at the beginning of the quarter have to sell it to get rid of it. Fundamentals don't mean squat to these people. If this stock were at 88 and that announcement came out, that's a $100 stock. That stock's up $12. Done. Book it. You remove all the tariffs and it's gone. Okay? Because the stock is in the penalty box of window dressing where they have to sell it to hide it because it's down for the quarter, the fundamentalists won't buy it. They will buy it. It's the technical analysts, money managers who run by charts that won't touch this. It's sad. Just remember, they're not going to have to pay tariffs. The reason why it walked it down, because they were worried about Trump slapping tariffs. Now he says he's not going to slap tariffs, and the stock is stuck in the mud. That's what window dressing does. Window dressing obfuscates and makes money managers' brain turn to mush and bananas. They know they want to buy it, but they're like, I can't buy it today. Why? Well, it's not the end of the quarter. Oh, but next week I'll buy it. Screw it. Buy it now before it moves. The stock is deeply oversold. It's cheap. They're going to beat their numbers. They've already raised guidance. Again, this is one of those things. It's a rotation thing where they won't buy it until next Wednesday. Sad, pathetic. The stock is not going to be slapped with tariffs. They already built a plant, so they're not going to be assessed. Ugh. Do your homework like I do, okay? Last but not least, easy does it. Boeing. I've said this time and again about Boeing, okay? Boeing is off my list forever. I'll never short it. I'll never buy it. I don't know how to price it. Neither do you. Neither do the analysts. It's just a big bold-faced lie. It trades purely on sentiment, rotations, cyclicality, seasonality, and order flow based upon how many jets they order. The bottom line is this. I told you this is a bad short. And you can come at me and say, but the valuation's wonky. Doesn't matter. Boeing gets an asterisk next to it. There are 3 stocks in the market where the valuation means nothing at any point in time. That's one of them. You can't. Boeing is a lumpy, cyclical, wacky business where they get orders canceled, they get sued, they have flights that get canceled, they crash and burn, and then they just come back because another country's like, we'll just take 40 jets. It's the wildest, most volatile stock. I kept saying, this stock is technically oversold in the Genesis Cog model. Don't ever short oversold. If you got burned, good for you. Shame on you. Do not short this ever when it's in an oversold condition. The company basically got eased restrictions. Boeing got cleared. They freed it. The FAA will allow limited delegation to Boeing for issues. In other words, they're easing Boeing's trouble. They're not going to hold Boeing to a certain standard in certain areas of the business. The easing automatically lifts, creates a gamma squeeze. For your health, for the sake of your health, please don't short this unless you're an expert like Don. This is a widowmaker. I'm telling you right now. It will destroy your portfolio in ways you can't imagine. If you're going to short this, it better be defined risk. It better be. Now, without further ado, I've got about half an hour left. Let's get into the AI trade spy. Let's go spy some trades. And I'm going to show a lot of you. And this is not about bragging. It's just trying to explain. It's really what it comes down to is it's me standing behind Garrett Baldwin, because Garrett made a statement this morning. And he made a very cogent statement. It's very telling. It's very timely. Garrett's telling you that the algorithms are really messing up this market. Don told you this morning that when the market opened up 40, don't bite on it. Let it play out. The algos could mess up your trade. I told you, if you don't understand algorithmic trading, you're going to get ripped asunder. One way or another, you're going to lose a lot of money. I call it, and I'll borrow Ross Bowering. You're just financial roadkill for these people. They'll just take your money and just you're giving it to them. I'm going to give you the quick technical reading on the market today. Okay. And then we're going to go to 3 stocks that we are positioned in. 3. So the technical reading on the broader market is pretty simple. Okay. My technical reading looks like this. Okay. I know a lot of you look at the daily chart. I'm not going to look at you. I'm not going to, make fun. I'm not going to diss you. I'm not going to criticize you. Daily charts are fabulous, but they don't hold a candle to the weekly. The problem with the daily charts is that they don't create what I call a visual, smoothing factor. They just don't do it. In order for you to really understand what the algos are doing, let me explain how an algo works, because I've been doing this for a long time. I was born in the incubator at Thinkorswim 10 years ago. I was on trading floors. I've worked for years with algo, with prop traders. I understand how they think and how they work. You're thinking that algos work for the second. They do. Algos trade for the moment. Their trades are in, they're out, in, out, in, out. You blink and 10,000 VWAP sprays are done. You're like, oh my God, it's done. But there's what's called fractals. And it means that you're like taking the puzzle and you're just smoothing it out. They're like pieces that you just join together. And if you do like a scatter plot where you add each piece of the puzzle, a pattern develops. So what you see on a daily chart is a pattern, but the daily chart itself can give a little bit of slippage at times. The weekly chart eradicates that slippage is what it does. It neutralizes it. But when algos trade, they trade in different time frames. It's called a superimposition. It's an overlay. They can see things in the moment. They can see it by the minute. They can see it by the hour. They can see it by the day, and they can see it by the week. They can see all of them. They can literally see it all. Sometimes they'll agree. Sometimes they'll disagree. Sometimes they'll synchronize at the exact same point, which is maybe like a buying opportunity or a selling opportunity. But the idea here is when you're trading algorithms, you cannot fight the direction and you cannot fight the slope. You're not going to ever make money because it's like a gigantic force of a wave coming at you in size. And your one lot of an option is bupkis. It's like a drop in the ocean. You have to ride that wave up or down. So when you're looking at a chart like this and you're looking at daily, it's all good. For me, I look at the daily, but I flip to the weekly because with the weekly, I get so much more clarity and separation in the Genesis Cog indicators. What I'm seeing right here is we've completed the full cycle. It's completely done. We're done. We're not going up anymore. It's not. We're not. We may go to 667 and 68 and we're done. We're done. When do we go down? We're not going down until the MACD rolls over. The trigger in the whole system is the MACD. But the RSI and the stochastic are basically warning systems. The MACD is not a warning system. It's just a trigger. The other two are warning systems, and the money flow is also a warning system. You have 3 warning systems against a trigger. So when you're looking at the weeklies, okay, and this is to Eric out there, you could be in a trade inside the Genesis Cog for years, or you could be in there for 15 minutes. It just depends upon how long you want to stay in the trade, how much you want to make in the trade, and what the algos are doing. So if the algos are running stuff up, case in point, look at WDC. How's that one for you, Eric? I owned this one. I sold it early. I sold it in the 70s. Look at it. It went, look, it just kept going. You can't short that. It's impossible. There's no chance to short something that looks like that until maybe now. Now you got a puncher's chance. But in that whole way, you had no shot. You have to realize that the way the E-mini is set up right now in the moment is simply this. It's a road to nowhere. We're not going up, but we're not going down either. We're not going to break the channel. We're not until the MACD rolls. When the MACD rolls, it's a game changer. When will that happen? I don't know. Let's you and I watch each day. We'll wake up each day. We'll break bread. We'll have a beer and we'll watch every day. I don't know. I have no idea. I just watch it. Never fight the trend. That's a Corey Rosenblum, Gianni. You can't do it. It doesn't work. There's no people. It's machines that are just taking over the market. It's algobots. It's iRobot. They're walking this. And in between, a bunch of managers are like, buy that, sell that. Yeah, but they're doing it in off days. They're doing it maybe once a week. A hedge fund will trade once a week. Algos are trading all the time, 24 hours a day, every second. It's different. But algos don't trade in size. Okay, they trade small, divide the order up, stagger it, and money managers trade in size. That's the difference. So when algos see size, okay, they can flip and turn on a dime and change tempo. But without size into a trade, it'll just continue on its path and keep going that direction, divorcing itself from fundamentals. You have to realize this. So to me, this setup is telling me we're not ready to go down yet. We're not, but we're getting much closer than where we were maybe a couple weeks ago. You can't short on the way up. It doesn't work. You have to wait until this curls. It has to literally lip curl like this. Then it's a game changer. Now, what do I mean by that? All right, let me show you some of the trades that are just absolutely they're just killing it. I'm out of this trade. That's a home run trade for you. That's not a home run trade. For the Genesis Cog, it is, because all we look to make is 10 to 15%, 20% on a trade. We tend to move on most of the time. That was a big winner. Why? Because as soon as it turns blood red, that rolls, and that rolls, it's a layup trade for me. I don't got to do anything. I'm not smart. My only intelligence is the ability to read the candle. Apart from that, the algo does all the work. I give algos all the credit to make me rich and the Genesis Cog members. It's the algos. It ain't me. I'm only short a couple hundred shares and a couple call spreads. How can I move it? I can't move it. But collectively, the algos, like a scatter plot, it's like throwing flies into a trash can. More and more and more and more. It's the F equals MA, force equals mass times acceleration. The more mass you have, the more order flow, the more algos that are hitting it, firing order, keep driving it. That's how it works. Okay? Algos don't buy down slopes. You do. That's the difference. They're not buying that. That's how I knew I was going to make money on it. Now, let me give you the one that I'm currently in. I told you, I'll give you a little sliver of this so you can run this through your head. I can't make money shorting. Then join the Genesis Cog and just relieve your stress. Here's another one for you. Ready? Let's look at Unilever. But it's so boring. Yeah, but it's putting my kid through college. Okay? Unilever. Look at that one. Where did I hit it? 63.5. But you're only up $4. You're missing the point. I'm short call spreads. They're going to go to zero. I got 100%. You get 100%. Any of you have 100% return? Then call me. Look at that one. Okay. All I did was I identified the reversal. I looked at the value and said, this makes absolutely no sense because the company has zero. They have zero growth. Zero. None. They're not pyramiding earnings. The only thing that can hurt me here is a rotation. And they rotated up. Why? Because as they're rotating out of tech and financials, they rotate into food. Oh, wait, now they're rotating out of food. This is like the Procter & Gamble of Europe. Now they're rotating out, right? Because consumers are spending less. I got it there. I wasn't looking for a home run trade. I'm never looking for a home run trade. I just want to make money. And I want to make money in the least amount of stress and the lowest risk possible. I teach this for a living at Loyola. The mean variance criterion dictates that if you are able to manage risk and you have the lowest risk at the highest return, the probabilities of being a millionaire are supremely high. And if all you ever do is trade with high risk, high reward, the probabilities is that you'll go broke. It's a fact. You cannot trade without managing risk. It's impossible. Ask Don, ask Blake, ask any TheoTrade instructor. If you ignore risk, it is going to cost you. The obsession for me is I will lose money on trades. I do. Everybody does. The thing is, my losses are contained and all my trades are at a point where when I lose money, I laugh. You know why I laugh? Because the risk is so low, it's worth the time to take that trade. I just don't short on the way up. That's the key. I just don't. And I don't buy on the way down. I try to get it to a point where it's flat or it's turning and it's going to make a move at some point. And I'm not just looking for rotation. I'm looking for value. I'm looking for order flow. I'm looking for institutional participation. I'm looking for catalysts. I don't live in a box or a vacuum, people. Now, the Genesis Cog scanner is purely technical. It's completely divorced of any fundamentals. So we have a two-part system. You've got my alert system, which includes fundamentals, which are quantamentals, or you can just go to the scanner like Matt Menster does and just load up and make money all the time. That's what he's doing. You can do it any way you want to. Matt is a trader. He gets in, he gets out, he books. He's an options trader. His account's up so much, I can't even tell you. I'm not like Matt. He goes in and out. I prefer to stay in the trade, let it marinate a little bit more than Matt does, but each to his own. The reason why we created both the scanner and the alert system is to appeal to every type of person. Eric, everybody can trade it. You can invest in it, you can trade it, you can scalp it, whatever you want to do. The stock is still on the way down. I'm still short a couple of call spreads. Now I covered my short stock. I booked about $350 on it, which is fine. It was 100 shares. But why am I not going to cover this? Because my short call spread, it expires next week. Why do I need to cover? I'm $3.50 out of the money. And the stock has got no levity to it, and it's still on the way down. As long as it's on the way down, I'm not covering. If it starts to turn and curve up, I'm out of the trade. I'm done. I'm out. Or if it hits an oversold condition on any of the oscillators, I'll bail. I have many ways to exit the trade. But the thing about the trade is we always focus on risk. When I shorted it up here, what's my risk? Oh, it's $1. Look down. Road to nowhere. The reason why I chose that theme today was to tell all of you, stop looking up. Stop it. Look down. There's more opportunity to down when it's overbought than when it's oversold. And when it's oversold, look up. Look up where it used to be and see if there's an opportunity for it to reclaim its glory based upon value, catalyst, whatever, overreaction, whatever you want to legitimize is your reasoning. I looked at this and said, this is stupid. I'm taking that trade. That's me. Then I added more over here and then it blows. I'm still in that trade. So for somebody who says, oh, you're a trader, does that look like I'm a trader? I'm still riding that thing. And eventually I'm hoping if I could exit at 57, that would be like the best of all possible worlds. But I'm not sure it's going to go there. I think it's going to start to build and bounce to 62. I just have to have 7 days to go by where it doesn't go above there and I max out. I sell call spreads for a reason because I make more money on theta decay than I ever make on the price. Half the gains in the Genesis Cog this year are theta decay, people. Theta decay, not price movement, theta decay. Because I time it right, and if it doesn't go up or down that much, it doesn't matter. Time burning makes me money. It adds income every day on the delta, people. That's the key. So this is one of the Genesis Cog winners, and that's a boring. Don would never trade. Don's like, that piece of crap, I'll never trade. Of course you'll never trade it. I know that. You don't have to tell me. Everything I trade, Don, that's nothing to do with. He likes sexy. I hate sexy. It's terrible. Tractor Supply. Here's another one where the Genesis Cog members just absolutely cleaned up on. Another one. So Tractor Supply. What's the deal with this one? Okay, this one was a little tougher. I said to myself, okay, cyclical stocks, economy's turning, slowing down. I see Caterpillar going up. I see Deere going up. This is a little trickier because those stocks, Caterpillar and Deere, are sacred cows. I don't short sacred cows ever. That's not a sacred cow, so that opens the door for me. But I look at the stock and I'm like, well, what's the growth rate? It's about 5%. Then what the hell is it trading at 27 times earnings? That's an arbitrage. That's an arbitrage play for me. I'm a value guy. That's the easiest trade I've ever seen. That's not going up. How can it go up? Their earnings, this doesn't legitimize. This is just pure financial porn. It's just going up on an algorithmic incursion. There's nothing behind it. So I'm like, okay, I got to pick my spot. How do I pick my spot? I just use the indicators. I had to get past the dividend. I did not want to get hit on the dividend. I just didn't. So it goes up. I get the reversal right there on the 29th. So I'm like, that's it, Tractor Supply. It starts to break under right around there. So I threw in the short right there at 62.25, sold a couple of call spreads, sold a couple of 100 shares. It drops down to 57. I took off 100 shares. I just booked the gain. Why not? It's $500, right? I'm still short my two call spreads. One expires next week. One expires the week after. Okay. If it goes up, I cover. The problem is it's under distribution. Look, they're selling it out. They're getting out of it. What am I to worry about? Nobody's buying it. They're selling it. They're getting out of it. They're beginning to realize, oh, this is a really overpriced stock. You're damn right it's overpriced. Of course it's overpriced. Here's the thing. I got it right on the curve. I keep telling all of you, the lip curl is the death knell of your stock. If you own a stock that looks like that, your account is in trouble. You're going to die. You're going to burn. Do not. Algos sell that. They don't buy it. Algos react to slopes. When you're going to learn it, people, look how the slope rolls over. I was like, slope's rolling over. I got about 5 emails the next day. 5 Genesis Cog members go, damn, that's getting killed. I said, I know. Just follow the bouncing ball. Follow the model. It works. Look at it. It's not going up. The market's up today. Pound. The market jumped today, 40. Stock was still down while the market's up. Who's going to buy it? Window dressers are not going to buy it. It's on the way down. Dead cat bouncers are not going to buy it. Momentum traders are not going to buy it. Value guys are not going to buy it. Who's going to buy it? Nobody. They might buy it if it drops maybe deep enough, maybe down to about 52. At that point, I'll probably bail on the trade and walk away. This is what the Genesis Cog does. I spot these trades. I put in 4 new trades alone yesterday. 4 of them, people. 4. So you're like, I can't find any shorts. I can't find enough of them. They're all over the place. You have to curate. I call it hunt and peck. You got to hunt and peck, follow the model, or just join Genesis Cog, pay the monthly. It's reasonable, and you'll get all the trades you need. And you'll trade with me. You trade with me. So you put the honest thing. The honest is on Bierman. Of course, every trade I post in the blotter, I'm in the trade. It's on my trade system. I'm taking all the trades. So you know what? I have skin in the game. I track all the trades, so nobody needs to remind me. Last one. All you talk about is bearish. You're so bearish. You're so mean. Really? I'm the guy that pleaded with the Genesis Cog members. Stop calling me on Devon. I got about 10 emails on Devon. Wait, it's going down. How? I never broke a sweat on this. I kept saying it's in an algorithmic, ascending triangle. You have a 67% chance of making money in this trade. Whoops, there it is. Look for yourself, TheoTrade members. There's the long. There it is. I bought the stock at 32. What did I do? I cleaned my fingernails. Hey, Eric, I've been in this for 3 months. I haven't sold one chunk. I added more. I got 400 shares of this baby. 400. I want to buy more. Okay, why buy this? Because I can see the algorithmic setup. The weekly's breaking out. The RSI broke out. Okay, the Stokes breaking out. Money flows coming in. It was already coming in ahead. The only reason why the stock went down for 3 days is because they couldn't control their bowel movements to sell it because it was a window dresser. Get bent. Don't window dress. It's dumb. Hold on to it. If it's cheap, Garrett does this all the time. If it's cheap, what does Garrett do? He goes lawn bowling. He goes out for a massage. I don't care. When it's cheap, I never break a sweat. Are you kidding me? If you doubled the multiple on that, it still wouldn't be expensive. If that stock went to 74, it still wouldn't be fully priced. That's how I do it. I find the cheapest stocks out there. I just find the algorithmic incursion. The COG says, look for the lowest risk at the breakout point. Gianni calls it the icebreaker. Same thing. I'm just looking. There, whoops, there it is. It's gone. Now it's going to go. Oh, it's up 3%. Come to me when it's at 40, 50. People are going to go, oh my God, this stock's really cheap. You really think so? At 8 times earnings when it's growing at about 20%? You think? Some people would rather pay for Dash, which is growing at about what, 10%? And pay 1,000 times earnings. I won't short it, but I know where to find value. I know how to read the algorithmic. I can read the algorithms. I can see what they're doing. Look at the algorithms. I saw that. I just said, wait 2 days, it'll break. There it is. I got other oil stocks. I don't get rattled by day-to-day movements. I let the COG keep me in the game. And if something breaks and it violates a support level where I'm vulnerable, I just close out some of the position. I took a small loss. I took a quarter position loss today on BJ. It's okay. Can't make money on every trade, but I know where to find it. I'm starting to kind of piecemeal my way. I started piecemealing my way. I'm watching it, people. I'm going to get it. I'm not fully in there, but I'm getting close. You get that above 91, that's going to be my biggest winner in the fourth quarter. You won't touch it. It's not financial porn. I look at it and go, are you joking? Are you joking at 10 and multiple? You would rather buy Walmart at a 50, a 36, and not that at a 10? Really? Anyways, that's the Genesis clog spotting. I gave you 3 trades. The Unilever trade, it's played. You've missed it. You're done. You can't take that trade. The risk is no longer in your favor. I gave you the Tractor Supply trade. That's as an example. That trade's done. You can't take that trade either, theater members. It's done. That trade's played. You blew it. You have to come and be a cog member and catch it right at the lip of the curl. That's how you do it. The Devon is not done. You can actually go in and buy that today and see if you can ride that to 40. But then again, I got in at 32 and a quarter, so I'm way ahead of that. And I just didn't get, day by day, it moves up and down. I don't get rattled. As long as it stays in that algorithmic channel, I just let it play. If it breaks the channel, I cop up and go, screwed up, bail. But when I bail, oh my God, I lose a couple of points. It doesn't really affect me. I'm here to make money, not to be a hero. Last thing I want to throw out is this. Death to jargon. This particular part of the monthly Genesis Cog spotting was created by Ross Bowring. Death to jargon is just a little segment that says you hear certain words on the TV, you read it in a book, you see it on a social media site, somebody comes out on a program, the internet, a webinar, TheoTrade, and says, tracking error, and you're like, oh no, it's a fancy PhD word. You get freaked out, you start shaking in your boots, you have to go to the bathroom and vomit and call the therapist. Calm down, I'll tell you what tracking error is. Tracking error is simply that when money managers go out to try to make money for you, okay? This is what matters most to a money manager, and I'll explain this to you, okay? If you're wondering why most money managers underperform the S&P, okay, or they're a little bit above it, is because technically speaking, they're not paid to destroy the S&P. Now, Gianni DePoce is paid to blow out the S&P. He has to get a return 3 times or he's not worth the money. He knows it. But most money managers, asset managers, broker dealers, Fidelity, Morgan Stanley, Goldman, okay, their goal, they're not hedge funds. Hedge funds are concentrated, high leverage plays that have to beat the benchmark by a substantial amount so they can get a performance fee and you get what's left over of the scraps. Most, if not 3/4 to 80% of all trading is based on a tracking error. A tracking error simply, as described, just described in simple English. It's just simple English. I can't simplify it any more than this. It's just simply this. And you need to understand this because the more you know, the smarter the trader you become. P is the portfolio. Whose portfolio? Your portfolio. All your positions, long and short, your total return, okay? I stands for the index or benchmark. We'll just label that I the S&P. That's you on the left, that's the S&P on the right. The differential, the net is a tracking error. Let's say ABC fund tracks the Sensex, and in the previous year, it got 10%. Well, the ABC fund returned 9.7%. The difference between the two would be subtracting the return of the active fund, which is the Sensex, to the ABC fund, to the Sensex. Net, the tracking error says it tracked within 0.3%. Okay, what does this mean to you? Okay, it's what we call in the business guardrails. They're guardrails on the S&P. Most funds in the world track the S&P. They're not designed to get a return much above it. They're not. That's been fooling all of you. And they're not designed to get much below it. If they get much below it, they're fired. Oh, they're fired. They're designed to track. They track the S&P as closely as possible. Why? Because they're running a fund where they're trying to take on a little more risk than the S&P, okay, to get a better return. But they have to keep their risk aligned with the S&P to get that return. Because if their risk doesn't align with the S&P and they take greater risk and blow it, the average person will say, well, why do I need to be in this active fund when I can be in the S&P? Higher return, less risk, cheaper. Get it? That's how it works. So most money managers buy the same stocks. Everyone, nobody's different. They're all the same. But they have 10 different, they're the same. All of them are the same. They buy the same. They own Microsoft, NVIDIA, Palantir, Netflix. They all own the same crap. Okay, stop. All they have is a little bit of differential weighting And then with that weighting comes a little bit a different risk profile. So the differential between the return of the S&P and what that portfolio returns is what managers care about most. So when you're out there trying to figure out like, well, why is the S&P not breaking? Because most money managers track the S&P. So if all of a sudden the S&P starts to break outside that tracking error or that channel, it means the manager's tracking error, they could lose a lot of money outside the tracking error. Their volatility could explode. So what they do is they kick in a tracking error based upon return and based upon standard deviation. Return is the performance. Standard deviation represents the variability around that performance. So they have to do what's called tracking error based upon performance, which I showed you, and tracking error based upon standard deviation, which is risk. So the risk and the return have to align with that tracking error. They don't have to exactly equal it, because if they do, they're worthless. They have to be a little bit higher on the return and maybe a little bit higher on the risk, or they have to be higher on the return and a little less risk to be efficiently designing a portfolio. But if the return and the tracking error are both substantially higher than that benchmark and it underperforms by, let's say, 8%, that manager is going to lose his job. He'll get just completely smoked. He'll get beaten up alive by his clients. They're not heroes. Contrary to what you think, they're not heroes. They all buy the same crap. All they do is they change the weighting scheme to add a little bit more risk here, to generate a little bit more return there, to beat the S&P and to match the risk. So if they can track the S&P, okay, what their bragging right is this. If I track the S&P and you give me money, I go, listen, the S&P's up 10% this year. I'm up 9%, I'm up 11%, and my risk is a little bit less. You're like, I'm happy. Then again, it's almost like I'm aligning myself with the S&P. You'll pay me because I'm an active manager. But what you don't realize is I cost 4 times as much as a passive index. Get it? The passive index costs 4 times as much as the active manager. So the active manager only wants to align with the S&P to get a little better return, a little lower risk, right? And then keep the client in the game, because the client's entire focus is the S&P. That's the hurdle. That's how you match. You mark yourself. How do you gauge somebody? Like, it's not like you're going to the Olympics, like that's a 10 on the vault for gymnastics. It doesn't work like that. Everybody's compared against a benchmark's return and the risk. And the tracking error is like the guardrails you must stay within in order to generate the return against that risk. You go outside those guardrails, your client is going to freak out, because they're like, that risk could put me into a black swan and tail risk and blow me out. Exactly. So when you're out there telling me like the market's going to run away, it's not. It's run by algorithms, and most managers know that nowadays. Their only goal is not to blow up your account. They're not looking for a 25% return. That's not true. They want to get the same return as the S&P with a little lower risk so they can justify them overcharging you 4 times as much for your management fee. That's the God honest truth, people. Know what a tracking error is. Everybody lives and dies by it. It's one of the most important things. I teach it in applied portfolio management. All students have to work within that tracking error. And if they don't, and the risk gets out of control, they could blow their accounts. I don't grade them on their performance. I grade them on their process. It's more important. Remember that. All right. I am done for the day. We are done with Genesis Cog spotting. I am going to spend the rest of my day sitting behind this desk, and I'm grading them online. It's a take-home exam. I'm grading them online. They're in front of me, and I got to sit there and crunch them out, 50 of them one at a time. So thank you for joining me. I do appreciate it. I'm just waiting for our next guest to join us. So if you give me a moment so I can double down and see who it is, I got to check with Donald Kaufman and see who he put behind me. So today, it's Brandon Chapman and Blake Young. So I tag team with Brandon yesterday. Today, Brandon's tag teaming with Blake Young. So I'm going to wait for the gentleman to show up, and I'm going to tell you, like, okay, I'm sitting here, I'm waiting. I'm going to tell you thank you. Oh, the Alaska trades, it's too late. ALK trade, it's gone. Jambi, come on, man. It's gone. You can forget it. It's too late. You missed it. I'm going to omit Blake, and then I'm going to turn it over to him, and I'm going to run. And, I've got I got 2 jobs. I got a Heyman. I got multiple jobs, right? Rick S., you rock, buddy. All right. Blake Young, are you here, dude?
I am now.
Okay, so what I'm going to do is I'm going to jump over to Zoom. I'm going to exit. I was told, maybe erroneously, that you and Brandon are teaming up today. Am I wrong?
Yes. No, that's right.
So where's Brandon Chapman?
He's having an OS issue.
Operating system, OS operating system?
Or yes, operating system.
Okay. Blake, I keep telling you, my entire quarter performance, which is going to end, I'm up for the quarter nicely. It's all in the short trades. All my short trades except for one cleaned up.
Nice.
I know. The longs haven't come through yet because I'm waiting for that quarter end rotation, Blake. And I listen to you. So I'm going for the stocks that nobody wants. I want those consumer staples, and I want some of those drug stocks. And by the way, Blake, I loaded the boat on oil stocks earlier in the week, and they're breaking out.
Nice.
Yeah.
Very nice. Yeah. And we broke, if you remember, I always like saying 65, 75. So we're above 65 again. So we might be going 75. And that's a sign of inflation as well. So inflation again.
Blake, I'm with you. I keep calling it stag. You're
Yep.
so nice. It's just stagflation. Just call it what it is.
It is. Oh, I call it that too. Yeah, it's bad news. And those are when those consumer staples do well. And I'm going very much into those that are highly defensive with their debt coverage. That they're going to be able to.
I'm waiting into General Mills now, and I'm waiting into Merck. Those are my trades. That's what I like.
Awesome.
All right.
I like it.
All right. Have a great weekend. And I'm sure Brandon will jump in.
Yeah, he'll come when he gets here. That's fine.
See ya.
Thanks. Appreciate it. All right. Hello. How are you?